Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today's theme is Federal Reserve policy. Mayday, Mayday, a wing and a prayer. The FOMC lowered its target for the federal funds rate 25 basis points to 2%. Today I dissect the FOMC statement released at 2:15 p.m. yesterday. My first blip describes the first paragraph of the Fed statement as an admission that the FOMC remains extremely worried about economic growth. Recent information indicates that economic activity remains weak, household and business spending has been subdued, and labor markets have softened further. Financial markets remain under considerable stress, and tight credit conditions and the deepening housing contraction are likely to weigh on the economic growth over the next few quarters. This tells me that the FOMC still thinks that GDP will contract in the first half of 2008 and that the fiscal stimulus plan will not help the economic recovery in 2009. My second blip describes the second paragraph of the Fed statement as saying that the FOMC is concerned about inflation. Although readings on core inflation have improved somewhat, energy and other commodity prices have increased, and some indications of inflation expectations have risen in recent months. The committee expects inflation to moderate in coming quarters, reflecting a projected leveling out of energy and other commodity prices and an easing of pressures on resource utilization. Still, uncertainty about economic and inflationary outlook remains high. It will be necessary to continue monitor inflation developments carefully. The Fed is operating on a wing and a prayer, and by cutting the funds rate to 2% risks a weaker dollar and continued commodity speculation. My third blip analyzes the third paragraph of the Fed statement. So the substantial easing of monetary policy to date, combined with ongoing measures to foster economic liquidity, should help promote moderate growth over time and to mitigate risk to economic activity. The committee will continue to monitor economic and financial developments and will act as needed to promote sustainable economic growth and price stability. This tells me that the Fed really has no clue about how to manage monetary policy during the beginning of the great credit crunch in an environment where rate cuts have only made matters worse. My fourth blip looks at market reaction to the Fed's monetary decision. The yield on the 30-year bond held the 200-day simple moving average at 4.615. COMEX gold should trade between the 200-day simple moving average at 821.4 and the 50-day at 938.9. NYMEX crude oil shows a potential double top at about 120 per barrel, with the 50-day moving average rising at 108. The euro held its 50-day simple moving average at 1.5570, but strength above 1.60 should be limited. The Dow poked above 13K after the FOMC meeting, and a close today below 12,788 alleviates the overbought condition and indicates risk to the 50-day simple moving average at 12,444. The Dow should continue to fail above 13K. Don't forget to join Traders Club on Right Side Live this evening at 6 p.m. Send your comments and questions to support at rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.